Well, let's welcome our next guest then, Rahul Arora, CEO, Nirmal Bank Equities, who joins us on the show. Hi, Rahul. Good morning and good to see you win. Well, I think you would be a little bit of a happy trooper. I think you all were cautioning your investors ahead of the event that maybe lightening some positions, maybe not taking very, very bold calls could work for you. And you're lucky, it worked out in your favor. But how do you approach the markets from here on? And, you don't stop short of giving us levels on the Nifty. So in the worst case scenario, what could it be on the Nifty?
Morning, Nigel, and thank you for having me on the show. You're right. I think, it is always prudent. History has told you that when you get a kind of move that you do on Monday, you generally do tend to take profits going into an event. I think if people held on to their positions into the event, I think they did so at their own peril. I think the correction was overdue, needed, and healthy. The reasons could have been different, for sure. I think it's gone anti-consensus to the market, as I'm sure you've discussed till the cows came home since yesterday. But I think it has restored a reasonable amount of sanity into the market in the short term. I think sector rotation had already started in the market way before this. I think if you remember when I was on the editors roundtable about 3 weeks back, we had spoken about shift already happening from IT to FMCG. And I think FMCG did have the best earnings season of any sector in India after a very, very long time. So on average, the market was about 250, 300 basis points technically underweight on FMCG. And I think you're sort of seeing that move continue. Obviously, because the largest state in the country has been lost by the single largest party, it is a no-brainer now that the government will have a tilt towards populist measures in the budget. In all likelihood, it does look like the current establishment will form the government. But again, then I don't think that's a reason to be worried about, because I think the RBI dividend, which was at 80,000-90,000 crores expected, was well in excess of 2 lakh crores. So they have that 0.3% fiscal deficit to play with. So net, I think whatever had to happen has happened. The high of yesterday, which is 223,333, I think, I don't see that being taken out at all before the budget. I think you're going to get into a range-bound market of about 1,000-1,500 points between here and the budget. So be ready for a very, very boring market over the next few days. The only one thing that could derail this is a negative shock, and you do not get an NDA-led government. And I think I do not think that the market is prepared for that. If that happens, then all bets are off. But I think the market now has just adjusted to the fact that it will be a weaker government, but led by the NDA. And the fiscal room that was sort of expected to be slipped on has been pre-adjusted by way of the RBI dividend. So I think all things considered, be ready for a cautiously boring market for the next 1.5 months.
Rahul, morning. I think you've just read my mind, because that was my question, and I kind of framed it in my head, and you just took it off. Because a lot of people in this market, those who've come after COVID, they don't know what a boring market looks like. They don't know how it is to sort of amble around for maybe 2 years. People are used to very quick gains, are used to every dip getting bought. So is that texture of the market changing? And then, then what happens to the whole surge of DII money that we've gotten so used to? That's the biggest cushion this market has.
So I think, Surabhi, I don't think SIP flows are going to fall off a cliff. That is not the case I'm making. It is very possible in the interim that these numbers of 18 to 22,000 crores on average could potentially go down to an average of 16, 18. It is possible. I'm not ascribing a probability to it. But, when you look at alternate investment classes, even today, Surabhi, whether it's gold, fixed income, real estate, they don't really look as lucrative as equities do, right? And I think so from that perspective, India has already begun on a journey of financialization of savings via digitization. And I find that almost irreversible. It's good that, I think post demonetization and post-COVID, a lot of the investors say in that age group of 18 to 25 are probably seeing this for the first or second time. I think it's a good thing to happen early on in your career. It makes you wiser, prudent, and more apt for investing as, life progresses and you have more responsibilities. But I think there could be a short-term, maybe 8-10% dip in the monthly SIP numbers, if at all, but I don't see any substantial derailment to that effect.
Rahul, morning. Sorry, what did you... I missed that one part I heard early in your careers. Did you mean a shock like...
To see a boring market for a prolonged period of time and then to...
No, but I think that's I completely agree, right?
Yeah.
What you see when you start, and I think it influences you a lot. I mean, people who started in the global financial crisis.
Oh, absolutely.
Right? I mean, then you kind of become...
Then you can take on anything, right? After you've seen the GFC.
Yeah, that's so, but then you're also kind of tuned to a particular kind of market because, everything that you heard at that point is that. And, imagine people starting right after COVID and making, which is, of course, the latest generation of people who came in. They've only seen up and up.
Absolutely.
But I think we've not had, as Rahul said, a boring market for a long time. The last I remember a sideways market, and it was painful, I can tell you, was 2010 to 2013.
Yeah.
The high, I remember 2010 high was about 63.50.
Yes.
That did not get taken out for 3 years.
Yes.
And then the rally, the Modi rally, was the first time when he began. It also coincided with that rupee crisis.
Yeah.
We hit, I think, 83 or something for the first time. And October of 2013 is when that rally began.
Taper tantrum and the rupee issues.
And the rupee bottomed out, and then we kind of had that rally into the election results.
Prashant, just one thing. Some investors say if you got in post-COVID, then you did see that painful period. But some investors, and someone told me this yesterday. He said, Nigel, we have been invested for 5-6 years old. So we saw the painful COVID period and then we saw the bounce. So it's not fair to say that only we saw the beautiful period. And I think I'll take that on board as well. Maybe they didn't see 2004 like some of you all would have seen.
No, but
they've seen some.
COVID was a very quick bounce, Nigel.
That's correct.
Yeah.
Actually, in the larger scheme of things, I mean, it's a 1 in 100 year sort of event, right?
Yeah.
But would you really call that as a bear market? I would not.
Yeah.
Right? Because it was, we had a fall. The Nifty fell 30-35% or whatever. And then there was a V-shaped kind of recovery. The last proper, in a way, a bear market was back at the global financial crisis. I mean, after that, we've not had one. And it's been, 14 years or something more since then. Rahul, I don't know if you want to come in on this one, but good point there. Go on.
No, I'm just reminiscing on my days, Prashant, because I think we are the last domestic institutional equities house to set up shop in India and grow. And we did that in November of 2010. I remember watching CNBC TV18 at that point around Diwali, and the Nifty high was 6350. In the early stages of me setting up this company, I have seen a Nifty fall from 6350 to 4400 3 times. And Prashant, you of all people would appreciate a fall from 6350 to 4400 is far more painful than a fall from 23,000 to 20,000.
Absolutely.
So we've seen that, we've ground through it, we've grown the business, we've seen the industry grow. And I think, Prashant, a big round of applause to the investors in India. I think, when we talk about industry sizes, right, and we keep talking about flows, so loosely, but which industry in the world, not even semiconductors, has grown from a 5 lakh crore market in 2016 to a 60 lakh crore market in 2024? That's the mutual fund industry in India, 12x. And if somebody told you in 2016, you'd see the kind of FI outflows and you'd still be at record highs, we would have scoffed at it. So, when I talk to investors and they talk about FI flows, I was like, unko aana hai to aane do, nahi aana hai to nahi aane do. We've carried it till here, we'll carry it forward. Their loss.
Fair point. And I think that's the biggest change, at least in our careers, that yes, we've had bear markets, we've had bull markets, we've had euphoria, we've had absolute gloom, doom. But the texture change over the last 20 years of having the Indian investor carry the Indian market on his or her shoulder, I think that's been the high point, at least in my career. But Rahul, coming back to the here and now, the here and now issue is when you start unloading off some L&T and a BHEL and an HAL and start going back to your, Lever or Imami or Dabur. I think that's the here and now question. People have taken a very simplistic view saying, okay, immediately let's do that. Is that the right approach? How would you look at it?
So, Surabhi, I think let's try and be a little brave in this market. I think FMCG has had a good run. Valuations are not really cheap. I think the cheaper ones like Imami have done a lot better post their results. I think they've seen a 30-35% move up. But I would actually start out venturing and buying public sector banks right now. You buy good companies in bad times. Balance sheets are clean. Asset quality is in control. We're heading towards an interest rate cut at some point this year. So I think the pressures on net interest margins will be well and truly behind us. Why not pick up a, SBI or a Bank of Baroda if you're getting them, 20-30% of the highs? I mean, these are stocks that are still coming to you at 14-15% ROEs at one-time price to book post the correction. So let's be a little brave. I don't think sometimes, following herd mentality can be counterproductive. Keep a little bit of allocation to FMCG. I'm not saying don't. And maybe, from the highs or that we saw day before yesterday, if you start getting defense stocks another 15-20% cheaper, start buying them. I think the wheels have been set in motion. Regardless of the eventual formation of the government, I don't think you can go back on the wheels that have been set in motion. or capacities are being set up, factories are going to come on board, orders have been placed, deliveries will be made, so earnings will follow. It is only a question of whether you're taking a 6-month view or a 3 to 5 year view. If you're taking a 6-month view, my portfolio would be FMCG 1, Pharma 2, PSU Banks 3, IT 4. If you're taking a 3 to 5 year view, I would go back to the theme that was playing out on Monday, which is anything to do with manufacturing, infrastructure, and cement.
Okay, all right. Rahul, talking about painful periods, 2004, 2005, I didn't see that. I saw that 2009, 2014, when we hit that upper circuit, I was in the exchange, in fact, and I was quite happy because we had nothing to do for the next couple of hours or so. But, talking about the 2004 painful period, the volumes in the markets, well, they flattened out for the next 2 years. And, if the markets lose some kind of interest or the volumes start dipping, then some of those cash market related stocks could see a bit of a lull. How are you all approaching the theme? Because the exchanges, stocks like CDSL, brokerage firms, they have seen a big surge in the last 12 months or so. How do you approach them?
See, Nigel, the way I look at it is, this is a market that's going to keep rising over every period of time. You have had events from terrorism to, biological issues to, train blasts. Everything has come and gone, but the market just finds a way to grind higher. Election results, you pointed out 2004. I don't think anyone was prepared for that verdict. It was my first election back in India. The India Shining campaign was at the top. But I think the depth of the market has changed so much, Nigel. And I think, at that point in time, impact costs was such a big thing. Today, no matter how big an investor you are, you really can't impact the price of a stock unless you're really buying a stock outside the, top 250, 300, in the BSE 250, 300. So I don't think to that extent, volumes are going to evaporate or there's going to be, any sort of, drama to that effect. Yes, I do see an impact on the primary market. That is for sure. I think fundraisers, primary and secondary issues could get pushed back because valuations have come off. So it's a great time if you're a promoter to buy back, so that is actually not a bad idea. If you have faith in your company, your stock price has fallen 20, 30%, it's a great time to be buying back your stock. But I think other secondary offerings or primary offerings could see a little bit of a delay by maybe a quarter from here. But I'm not too concerned about volumes drying up in a material way. Just going back to the point I was making to Surabhi earlier, even today, alternate asset classes are not as attractive as equities. So there needs to be a very compelling case for that to happen, for them to be a shift of volumes from one asset class to another. And just on the basis of what we've seen yesterday, I don't have enough evidence to make that call.
All right, Surabhi, just take a look at HUL. As we speak, the stock is up 6.5%, building onto yesterday's 4% gain. So the stock is up 10% when the markets are seeing some kind of selling. And this giant has woken up after underperformance for, I think, 4 years or so, not moved at all in the period that the Nifty tripled.
Correct.
You have HUL that's come back and come back in style. 65,000 crores of market capitalization in 2 sessions.
What I find and I was reading, I think it was one of those broker notes, was that, and it said HUL, or was it another consumer company, at 45 times earnings is pretty reasonable. I said, but that is essentially stunning, right?
Well, at least it's not trading at 70 times or 80 times like some of these EMS plays, right?
There is that. But
and you have cash in the company.
Surabhi, there is growth there.
Yeah.
HUL and all, I mean, what kind of growth are we talking about?
3 to 5%.
But I'll tell you one more thing, like a Novoma note said today, that industrials, they started approaching valuations that FMCG companies were getting.
Absolutely.
And that's why, in fact, you're getting a little bit skittish. So the arguments are on both sides. Growth, but some of these stocks, in comparison to what they've traded at in the past, I think they were, they're a little bit more.
When we talk about volume growth for FMCG companies, it is, I think for some of them, and Mangalam will know better, but I think
we're still talking mid.
Imami was good, but we generally are, I remember talking about 3, 4, 5, 6%,
exactly,
right?
Mid-single digits.
You talk about QSR companies, look at same-store sales growth. It's in that low
very
single digits. Even flat we've seen in some quarters, zero growth. So, Rahul, I don't know if you want to address that briefly.
It's a bittersweet moment, Prashant, almost an emotional moment to watch FMCG do so well, having started out as a consumer analyst myself. But since you're talking about volume growth, Prashant, I think if you look at the last 5 or 10 years, I don't think FMCG volume growths have compounded in excess of 5-6%. And for that, if the election result had not come the way it had, and I told you pay 45 times for it, you wouldn't. So I think there needs to be a material shift on the ground. Yes, there has been talk about offshoots of rural recovery. It looks like the onset of the monsoon is progressing well. Reservoir levels should hopefully, get filled up with that kind of rainfall that we're expecting. So hopefully everything should add up. But always remember, Nigel, just going back to a point, you probably haven't seen this in your career, but Hindustan Lever spent 10 years between 250 and 300 rupees. Prashant may remember this. And then when it broke out of 300, it headed straight to 3,000. It became a
2000 to 2010, yeah?
Absolutely, absolutely. And in fact, your own promoter company, Reliance, spent 10 years in a consolidation and then became a multi-bagger after it broke out. So some of these guys, when they move, the large ones, then there's no telling where it could stop and valuations become a bit unreasonable. I mean, you were discussing defense. We track it. We've been very bullish, but I'd be the first person to admit that the street had totally lost the plot in trying to do discounted cash flows for defense companies. I mean, when you get there, you are in a land of excesses that, is just giving you a reason to prick the bubble. So it's great that consumer is doing well. In fact, I would just add one more stock. Prashant, I don't know if you've discussed it this morning on your show, but V-Mart Retail, V for Victory, that gets about 70% of its business from UP and Bihar. And I'm sure that should also be doing well, because if you're talking about bottom of the pyramid consumption, this is one stock that will probably land up doing really, really well. I mean, I haven't seen how it's done today, but if the rest of consumer is up, I'm reasonably sure that's going to be up and above.
A couple of things, guys. I'm feeling quite young now. Prashant and Rahul, Nigel, you missed that 2000. So I'm feeling good, and I'm feeling like I'm the good luck charm also. Ye sab nahi dekha. The markets are good, they're going to do well from here, but markets are a teacher, and I'm sure they taught a lot of lessons, a lot for people who came after 2008, 2009 to learn as well. Young and maybe a good luck charm.
Absolutely. Why not? V-Mart is an interesting stock. Rahul, thank you very much. And interesting pick there. V-Mart is sub 6%. It's a rural-focused tier 3, tier 4, a retail player. It's a value retail player, basically. It's been down in the dumps for a long, long time. We've had the management many times with us, and they've been... I mean, I remember the last interaction after the earnings, quarterly earnings. They said that things are starting to look a little better. I mean, it was not any upbeat, very positive commentary, but it's one of the few there in that value retail space. I mean, Zudio is there, but of course, then you've got to buy Trent at 100 times. So, this is something to keep an eye out on. We'll